Welcome to the deep dive. Today, we're looking at life insurance a bit differently.
Yeah, definitely.
You've shared Chapter 10 with us, and we're really going to dig into its insights. It's surprising how versatile this can be, for personal stuff, for business stuff.
It really is. People often just think, okay, it pays out when someone dies. And that's true. That's the main thing.
Sure.
But this chapter, it shows there's just like a whole lot more to it. We'll look at figuring out how much you actually need, what individuals can use it for, how businesses leverage it, even employee benefits.
So, beyond just that basic idea, it sounds like there are some maybe unexpected uses we'll uncover.
I think so, yeah, some quite strategic ones.
Okay, great. So, let's start with that first piece. How much insurance is the right amount? Chapter 10 says it's not just a guess.
No, definitely not. It's presented as a planning process. You gather info, personal, financial, filed, figure out your goals, look at where you are now, make a plan.
And importantly, review it regularly. Things change.
Exactly. Life changes, finances change. And it highlights thinking about, lost income, obviously, but also lost services like childcare, household management.
Ah, interesting point. Okay, so how do you actually calculate the number? The chapter brings up two main ways.
Right. First is the human life value approach. Basically, it tries to calculate the present value of what you'd likely earn in the future, minus your own expenses, taxes, that sort of thing.
So it's focused purely on replacing the lost paycheck, essentially.
Pretty much. That's the core idea. Calculate the economic value, the earning potential, that's lost.
Okay.
But as the chapter points out, it doesn't really factor in other financial goals or needs someone might have beyond just income.
Which I guess leads us to the second method, the
Yeah,
needs approach.
exactly. And this one feels, well, much more personalized. It's about looking at specific financial needs and objectives your family would have if you weren't there.
Like what kind of needs?
Oh, all sorts. Funding college for kids, setting up an emergency fund, maybe leaving something to charity or a specific bequest, ensuring a spouse has enough retirement income. Concrete goals.
Got it. So you need a lot more detailed information for that one, I imagine. Ages, incomes, health.
Yeah, definitely. You need the full picture. It looks at lump sum needs, things like funeral costs, medical bills, paying off debts immediately, but also ongoing income needs.
And it considers assets you already have, right?
Yeah.
Savings, pensions, other insurance.
Crucially, yes, you subtract those existing resources. And it mentions Social Security benefits too, but also warns about the blackout period.
Right, that gap where a surviving spouse might not receive benefits between when the kids are grown and when the spouse hits retirement age.
hmm And life insurance can be key to bridging that income gap. It's a really practical look at the whole financial situation.
The chapter also mentions using life insurance for charitable giving. That sounds interesting, especially the tax side.
Yeah, it can be quite advantageous. You can, say, transfer an existing policy to a charity and potentially get an income tax deduction. Or you could buy a new policy, make the charity the owner and beneficiary, and then your premium payments could be deductible.
So a way to make a significant gift potentially more affordable. Smart.
It can be, yeah.
Now, the chapter briefly mentions some other methods too, like a simple multiple of your salary.
Right, like the 5 times salary rule of thumb you sometimes hear. Quick, but, very rough. There's also an interest-only method, aiming to just live off the earnings of the death benefit without touching the principal.
Oh, I
Or
see.
focusing on one single need, like just covering the mortgage.
Yeah.
And then there's the capital needs analysis, which is basically the needs approach, but like super detailed, breaking down everything.
Compared to the seat of the pants method, as the chapter calls it.
Uh-huh, yeah. Probably best to avoid that one.
Agreed. So, picking a random number is out. Okay, that gives us a good handle on figuring out how much. Now, let's talk about the uses for individuals beyond that core death benefit.
Sure, so the chapter confirms, yes, number one use, immediate cash when someone dies. Covers final expenses, debts, gets things settled.
Vital. But then it branches out.
It does. It talks about estate protection. Life insurance itself is property, and the death benefit can be part of the taxable estate.
Right, I saw that. Seems counterintuitive almost.
It can feel that way, but the key is it provides immediate liquidity. So if there are estate taxes or settlement costs, the insurance money is there to pay them without forcing the family to sell, say, the house or other assets quickly, maybe at a bad price. It creates an instant estate in that sense.
Okay, that makes sense. So it protects the rest of the estate.
Exactly. Then, of course, survivor protection providing ongoing income, but also funding education, paying off the mortgage, like we mentioned in the needs approach.
Now, you mentioned supplementing retirement income. How does that work?
Well, certain policies, like whole life or universal life, build up cash value over time on a tax-deferred basis. Later on, you can often borrow against that cash value or take withdrawals.
Ah, okay. So it's tapping into that built-up value.
Right. It's not its primary purpose, it's life insurance first, but it can be a potential supplemental source. You need to be careful about taxes and keeping the policy active, of course.
Sure. And we talked about charitable giving again. What else?
The chapter mentions using riders for disability or critical illness coverage attached to the life policy. And that cash value, again, it can potentially be a source for emergency funds, offering liquidity.
So it's really quite flexible.
It can be. The main point is a good advisor should be considering all these potential uses when talking to a client, not just the death benefit.
Definitely seems like a much broader tool than the simple view suggests.
Mm.
All right, let's shift over to the business side. Chapter 10 really gets into some strategic uses here.
It really does. Businesses use life insurance to protect themselves, but also to benefit owners, key employees, their families. It mentions using policy loans, for instance, to help fund things like buy-sell agreements or certain compensation plans.
Okay, let's break those down. Key employee insurance or key person insurance. That sounds critical.
It is for many businesses. Imagine you have an employee whose skills or relationships or knowledge are just absolutely vital. If that person suddenly died or became disabled, it could seriously hurt the company financially.
Right, big disruption.
Huge. So key person insurance is taken out by the business on that employee's life. The business pays the premiums, the business is the beneficiary. If the worst happens, the payout helps the business cover losses, find a replacement, stay afloat during that difficult transition.
And just to be clear, this is insurance on the employee, not the owner acting as owner, right?
Correct. It's about the value that specific employee brings.
Yeah.
Insurable interest exists because the business stands to suffer an economic loss.
What about taxes for key person?
Generally, the premiums the business pays aren't tax deductible. But the good news is the death benefit the business receives is usually income tax free. And it's not typically included in the employee's estate, assuming they didn't own the policy or have rights to it.
Okay, good to know. Now, what about business continuation? Buy-sell agreements. This seems essential for partnerships or closely held companies.
Absolutely fundamental. Think about what happens when a business owner dies. Who takes over their share? How does their family get compensated fairly? It can get messy and even jeopardize the business.
Yeah, I can see that.
So a buy-sell agreement is basically a contract set up in advance. It dictates how an owner's interest will be transferred upon death, usually to the surviving owners or the company itself, and at what price. And very often, life insurance is the funding mechanism.
Provides the cash right when it's needed, right?
Exactly. The death benefit provides the funds for the surviving owners or the company to buy out the deceased owner's share from their estate or heirs.
The chapter mentions different setups for a sole proprietor.
Yeah, it describes a plan where maybe a key employee agrees to buy the business if the owner dies. That employee might own a life insurance policy on the owner to make sure they have the money to do it. Keeps the business going.
Makes sense. And for partnerships, death can legally dissolve them.
It often does, legally speaking. So a buy-sell is crucial. Surviving partners use the life insurance proceeds to buy the deceased partner's share at a price they agreed on beforehand. Avoids disputes, keeps control with the survivors.
And there are different ways to structure the insurance. Entity versus cross-purchase.
Right. In an entity plan, the partnership itself buys a policy on each partner. When a partner dies, the partnership gets the money and buys the deceased share. In a cross-purchase plan, each partner buys a policy on every other partner.
That sounds like it could get complicated with many partners.
It does. Imagine 5 partners each needs to buy 4 policies. The entity plan is often simpler administratively if you have more than a couple of owners.
Okay, and for corporations, similar idea, just different names. Stock redemption plan.
Pretty much. A closely held corporation is a separate legal entity. So the entity plan is called a stock redemption plan. The corporation buys insurance on the shareholders and uses the proceeds to redeem the deceased shares. Cross-purchase still exists too, where shareholders buy policies on each other.
Got it. The chapter also mentions something called a Section 303 redemption. Sounds specific.
It is, yeah. It's a special tax rule.
Right.
If a large portion of someone's estate, like over 35%, consists of stock in their closely held corporation, and the estate owes estate taxes, Section 303 allows the corporation to redeem just enough stock to cover those taxes and some administrative costs without that redemption being treated as a taxable dividend to the estate.
So it provides liquidity for estate taxes using corporate funds in a tax-favored way.
Exactly. Life insurance often funds the corporation's ability to make that redemption, another specialized liquidity tool.
Fascinating how it plugs into these specific business needs. Okay, final area. Employee benefit plans using life insurance.
Right. This is about using life insurance as part of the compensation and benefits package, especially for attracting and retaining key people.
Like deferred compensation.
Mhm. This is where a company promises to pay an executive, say, later on at retirement, disability, or death. Often, the company uses the cash value growth inside a life insurance policy or an annuity to informally fund that future promise. Usually non-qualified plans, meaning they don't meet strict ERISA rules.
And salary continuation. Similar idea.
Similar goal, providing income security for executives if they die, retire, or become disabled. But here, it's usually funded directly by the employer. Can be structured to avoid ERISA rules if it's just for a select group of highly compensated folks.
Okay. Then there's CLI corporate-owned life insurance. We touched on key person. Is this different?
It's related, but CLI can be broader. The company owns a policy on an employee, pays premiums, gets the benefit. The chapter mentions a change of insured provision sometimes exists, allowing the company to swap the insured person if one key employee leaves and another comes on board. Offers flexibility.
And the tax treatment for CLI.
As the chapter notes, premiums usually aren't deductible, but the death benefit is generally tax-free to the corporation, though there are rules and limits, especially for policies issued after 2006.
Right. The chapter also flags corporate-owned annuities having different tax rules than personal ones, unless a natural person is the annuitant. Then, executive bonus plans, Section 162 plans.
Yeah, this one's pretty straightforward. The company gives the employee a bonus. The explicit understanding is that the employee uses that bonus money to pay the premiums on a life insurance policy that they own.
So the employee owns the policy outright.
Yes. The company gets a tax deduction for the bonus paid. The employee pays income tax on the bonus amount. But the key benefit is when the employee dies, the death benefit goes to their chosen beneficiary, income tax-free.
Nice perk for the executive. And lastly, split dollar plans. Sounds complex.
It can be, yeah. It's not really a type of policy, but a way of funding a policy, usually a cash value one. The employer and employee essentially split the costs, the premiums, and also split the benefits, the death benefit, and the cash value.
How does that work out?
There are different ways to structure it, but it can make life insurance more affordable for the employee. The employer might get its premium contributions back from the death benefit or cash value later. It's a way for employers to offer a valuable benefit, and they can often be selective about which employees get it.
Wow. Okay. We really have covered a lot of ground here. It's clear life insurance is much more than just that basic death benefit payout.
Absolutely. We've gone from figuring out how much coverage someone might need using different methods like human life value or the needs approach, all the way to these quite sophisticated business uses.
Yeah, protecting individuals and families, conserving estates, funding business buyouts, retaining key employees. It touches a lot of areas.
It really does. Personal planning, business continuity, employee benefits. It's a tool with many, many potential applications. The core takeaway seems to be its versatility.
Definitely. So thinking about everything we've discussed today, protecting your estate, maybe supplementing retirement, ensuring a business transition, rewarding employees, it makes you wonder, doesn't it? What overlooked financial need might life insurance potentially solve for you or perhaps for your business?
That's the question, isn't it? It's worth thinking about your own situation through this wider lens.
Absolutely. Definitely food for thought. Thanks for joining us for this deep dive.